guys, it's Tom Nunemaker with Capital Discussions, doing my trade review for July 16th. SPX was up today, about 8 points. So options expire on Friday morning, and we just have one trading day and then a wake up on Friday to see what happens. We're in pretty good shape. Our short deltas are minus 0.74. So if we look in option view, if we right click and select, where is it? Probability of expiring in the money. Option view is pretty much saying 0%. So option view's guess is a sure bet. Obviously there's no such thing. However, it's looking pretty good. So if we go to the analyze chart, here's what we're looking at. If I click on the expiration line, I can zoom out, and you can zoom out two ways. Use these plus or minus things, or if you notice when you put the mouse over it, the cursor changed. I can click, drag, and zoom in or out this way. It'll zoom in by dragging to the right, zoom out by dragging to the left, and if I click and hold, I can shift the whole chart left and right like this. If I hover over the standard deviation bars to see what the volatility it's based on and the points. Now if I go back, that volatility is based on the volatility up here. What I like to do is take the at the money volatility and add about 2 points. So if I use 8.7, you'll also notice these volatility shading or standard deviation zones will change when I hit enter. So right now it's here. When I hit enter, so you notice the one standard deviation expanded with the higher volatility. And the reason I do that, if we go down, we know volatility is going up, so I just add 2% just as a buffer. And now if we look at those standard deviation cones, remember you won't see it on T plus 0 because the standard deviations, the time is divided by 365 and the square root of that. But if you use 0 like today, then it's 0. It doesn't make any sense. So it has to be T plus 1 or greater. So like tomorrow, T plus 1 is here and expiration is here. Now you can change these if you right click on it. You can actually change the dates, and you can change these by date. So July 20th, you could do that. It wouldn't make sense. You can also use T0 or T, you can use T plus, like T plus 5 or just T5, and that'll also fill in the date. Now this knows that it's going to expire, so it's not going to go past that. And we'll just set the defaults back. So today, tomorrow, expiration. So you can see we're 2 standard deviations away to here, and we still haven't even gotten to our upper long put. So if I had to guess, I think we're about 4.5 standard deviations away from trouble, which is, yeah, a pretty small probability. If we look at the VIX, VIXCentral.com, if you watched the market analysis last week, you saw how Jim looks at contango or backwardation. Right now we're in contango. The VIX, it's normally, I get the mouse over here. So the August premium futures cost less than September, which costs less than October. And if you think about it, that makes sense from, like, if you think about the commodities like grains or something physical, where that extra cost over time represents the cost of carry. And that could be, you know, you need a grain elevator or a warehouse or something to store your commodity. If you have the commodity, you have funds to that you could have sold, you're losing interest. So the longer time goes by, then there's an interest component in the cost of carry. If we look at the chart, this is, what is this, 3 months daily chart, and it looks like we're still kind of in consolidation. If you use Joe Ross's thinking, this is from this line, the low here, which is, you'll see it over here when I hover my mouse over this bar candle, 1951, and the high 1979. I guess we just, oh no, high 1985. So call it 1986 to 1951 range. As long as we stay in that range, we're kind of in a consolidation. Not really thinking about a breakout. It's kind of trying, but it's had a little bit of a doji almost here. So, you know, it's maybe running out of steam on the upside short term. But for tomorrow, I don't, and Friday, I don't really see a big risk of it dropping down to, you know, like this level. That'd be a pretty massive drop. So that's kind of where we are. The trade at expiration should net out $1,517, which the margin, let me check, let's see. Right now we're using 45,403, so I can actually do the math on that. 1517 divided by 403. So 3.3%, which is about, you know, something what you'd expect on the upside for these kinds of trades. So that's a 3.3% return on the capital actually being used. So that's where we are, and hope you enjoy it. Thanks. Bye.